David, let's use your recent report on the uranium sector as a jumping off point for this conversation. You upgraded, or what's the word I'm trying to find? Here we go. Your report. Red Cloud has a new outlook on the uranium sector in general. New price assumptions, views on top uranium picks. Now, you cite a number of tailwinds in the sector, from government policies to security of supply. So can you give us kind of a brief snapshot and an overview of your report?
Yeah, well, I think it all really stems from the demand coming from the nuclear sector, right? The nuclear sector certainly has the tailwinds behind that, and that really is driving the uranium sector. So, you know, we are seeing positive government policies right now, whether it's out of the EU or out of the US. You've got the US throwing money at the sector. You know, a couple of years ago, they put $6 billion behind, you know, being able to keep some of these reactors online. They actually didn't necessarily need to use a lot of that cash, because the reactors were you know, they were being economic on their own. We are also seeing a lot of you know, climate change discussions, and that's really changed the outlook for a lot of the participants in the markets. You know, so what does that mean? That means that you know, nuclear demand requires more uranium. So right now, there's maybe 140, 160 million pounds of supply, if that. On the demand side, we're pushing about 180 to 100 million pounds of demand. So the demand side is really what we're watching. You know, there's that 40 million pound gap between production and demand that you need to fill. Secondary supplies are declining. But, you know, I think demand is actually growing more than people expected. You know, the World Nuclear Association came out and said, you know, demand is growing not 2.9% like we thought, but closer to 3.6%. So that means more uranium is required. And then, you know, you get into that started the big push in the latter half of last year in uranium prices. You throw in U.S. policy and financing the sector, and then you throw the Russian uranium import ban on top of that, and we saw a little bit of speculation there. And I don't think you can also count out physical buying, right? You know, the Sprott is now up to 63 million pounds. That's about $6 billion worth of uranium tied up in that one company.
Right. All right, great stuff. Nice overview. Mike, let's start with you. Could you describe your role at Sachem Cove Partners, and also the genesis of you getting the idea that, hey, uranium is a real asymmetric opportunity here around 15, 16?
Sure, Mark. So my role, I founded Sachem Cove in 2018. Been in the hedge fund industry for 30 years, roughly. Around late 15, early 16, always intrigued by a commodity that's down 90%. Number of equities are down, market cap's been destroyed. So the first 10 years of my career I was a short seller. So looking for bad companies run by bad people with bad numbers. So then I became a calmer, smoother person over time. But I said, but let me take a short seller's view of the bear case for uranium. And at that time, anybody that was a sell-side analyst, with the exception of Dave, had been fired if you were a uranium analyst, post-Fukushima. And the research was stale. Most investors institutionally who were there were stuck after Fukushima. They couldn't get out. So I decided to lay out all the world's reactors. I didn't know anything about nuclear reactors, didn't know anything about nuclear power, but you know, me and my guys educated ourselves. And what we first learned as a 1 gigawatt reactor, for instance, the pounds required for there is a function of enrichment capacity. And so it can go either way. You can have 20% swing, so you need to understand that. But after spending a lot of time looking at demand, modeling out supply for a couple of years, we realized that the industry forecasters were looking in the rearview mirror. They weren't even close. It was comical. And as a reason, and the sell side, any that did still reside except Dave, would cut and paste their models. So we saw you can't mine uranium at $50 to $60 a pound and sell it for 18, which is what the price was. So at some point in time, something had to give, and
right.
That's when I started Sachem Cove.
Right. And Guy, same question for you. You were fairly early in this cycle. Describe your role at Tribeca and as you view it, the main factors driving uranium right now.
Sure, thanks. So yeah, I joined Tribeca Investment Partners in 2017, coming from a career of 20 years of trading physical commodities and commodity derivatives. And we first came across uranium as part of our global natural resources business, where we run a global investment fund there in resource space. And I'd come in and looked at the fundamentals and a whole bunch of commodities, looked at all the energy products, the bulk products, and the guy that runs our business, Ben Cleary, said, look at uranium. I said, bloody hell, I'd rather stick needles in my eyes and model soybean seasonality or something next. And we looked at it, and of course it flagged as just broken. And that was around the time we started also, like Mike, a similar time, looking at investments. We started picking up some positions in the big fund. We were substantial shareholders in just about everything we touched, which became a little bit of a problem, not for the CEOs of those companies who loved it, but for us from that perspective. Yellowcake then listed on the AIM. We were looking at physical. We ended up being 9.9% of that or something. And so we very quickly realised we needed to spin out a smaller strategy to be able to properly get in the weeds of the sector with the view of, as that grows, pushing things up to global natural resources. So, that's how it started. And we, I think when we announced that fund, another prominent fund manager in Sydney said to me, you're going to be the shortest lived fund manager in the history of fund managery, which was interesting because I didn't realise that fund managery was a word. And fast forward 4 years later, and he's out on site with me in South Australia, saying, what, you've been out here before? What do I need to know? And I reminded him of that conversation, which he apologised over a beer later. But, it was a few years in the wilderness for the handful of us globally that were looking at the space. But at the same time, it was great because it gave us access to a pretty capital-starved sector that allowed us to get alongside and build some really good relationships.
Great. Now, David, in your report, one of the things you look at and compare and contrast is the 06, 07 run-up, that previous cycle in uranium, and compare it to today. Today, you say there's real demand compared to last time. Can you elaborate on that?
Yeah, when we were looking at uranium prices running up in 2005 to 2007, I would say during that period there was a lot of speculation. It was a lot of looking forward. People were still waiting for Kazakhstan to really prove itself. There were some supply issues. There was a fire at a couple mines. There was a flood at Cigar, and those really were some of the drivers that spiked the supply side. But there really wasn't the heavy demand in the industry like we are starting to see, like we have seen over the last couple of years. So, I would say the difference this time around is that we actually have the demand from the nuclear utilities. We don't necessarily have the supply that we think we need over the next couple of years, that we actually do need over the next couple of years. So we are getting a little bit of, uncertainty moving forward. We've got a gap in supply over the next couple of years, and we might have a couple of years of okay, depending who comes on, if we incentivize some production here in the next couple. But by the year 2029, there's a big gap between what is needed by the industry and what the uranium industry can supply.
Mike and Guy, could you both speak to the previous cycle compared to this cycle, compare and contrast?
Sure. So if you were a fuel buyer, the last cycle gets ascribed to Cigar Lake, the big mine from Cameco not coming online. It flooded in October 23rd of 2006. And everyone says from there the bull market was born. And that's just a fallacy. If you look at the math, the price of uranium was $7 at 2000. By the time that happened, it was almost $50 by the time that flood came. And if you were a fuel buyer and you were looking at all the forecasts, whether it was from UxC or the WNAs, or you were looking at a sell-side analyst forecast, and you said, okay, we buy over 5, 7, 10-year time horizons, and you looked out over a 6-year period. The month before the flood started, you would have seen the next 6 years, there was a surplus of 125 million pounds in the market. October 23rd, 06, there was a big flood, and a few months later, it was deemed that mine wouldn't come on for many years. And the price moved up from 50 into the 60s, but nothing dramatic. if you were that same fuel buyer and said, okay, let me see what's happening, and let me look at the new forecast coming out of UXC, the industry bellwether consultant, what you would have seen was a surplus of 225 million pounds in the market. And the fuel buyers got nervous for whatever reason, because they had under contracted from 1993 to 2005-ish by replacing only a third of what they consumed. So they drew down inventories. So there was a very big buildup of uncovered requirements for the future. So rather than, this industry doesn't have real price discovery, it's infrequent, they buy long-term contracts. One started to lead to another, to contracting, and all of a sudden, the producers stepped back and prices went parabolic. But at no time was there a deficit during that market. Fast forward to today, it's a realigned geopolitically enrichment world, conversion world. The fuel cycle has many parts where the Russians dominated, and that's shifting back to the West. If you bring on Kazakhstan to full production, they're 41% of the market. You extend Cigar Lake, the biggest mine, MacArthur River, add that. Bring on the newer 1, 2, 3 million pound mines. By our math, using realistic enrichment tails, which derives demand, you're looking at 20 plus million pound per year deficits as far as the eye can see, structurally. We'll see when contracting meets consumption. It had been from 2011 post-Fukushima until just very recently, they were replacing 37% of their annual demand, sucking down inventories. Well, then that moved up to 50, and last year it was over 75. You're getting towards replacement rate, and all that means is how much economic supply is available, not the spot market noise that people follow every day to see what the equities, that's nonsense. And we'll explain that in a minute if you want to go there. But how much economic supply is available? And the reality is it's not there. And so I don't know where pricing goes, but I know in the last cycle, it went up to $137 to 201 today's dollars on 225 million pound surplus. Here, there's a couple hundred million pound deficit. And you're approaching that point where price discovery is really inflecting.
Anything to add, Guy?
Yeah, look, I think the big difference this time from the demand side is China. And coming from a background of commodities since the late 90s in my career, anything that China structurally moves into where they're short the raw material is supportive over decades for the raw material, be it copper, be it iron ore. And you saw the beginning of China in that last cycle as they were trying to work out what they wanted to do there. They've now worked it out. They know what they're going to be building every year, and you put that in perspective. 2023 they approved 10 new reactors, and they're Hualong 1 designs. That's the equivalent of sort of 5 to 5.5 million pounds, or 4 to 5 million pounds a year that's going to be coming out of that, which is basically what you'll see this year from those brownfield care and maintenance projects coming up. So all of that work for the low-hanging fruit, and congratulations those in the room that have achieved that, is basically going to be consumed by the 10 reactors that have been approved last year. So that's not even solving for, as Mike was saying, yesterday's supply deficit, today's deficit, and the future deficit. The other big difference, I think, is that the West have gone from natural decline in their numbers of reactors coming to the end of their lives, competition from low gas prices, trying to force renewables onto grids, to flipping that back to flat with a small up. And so what you were seeing from that new build in China, where that demand equation wasn't as big, because that's flicked up as well. That's what the world's got to solve for. And I don't think the Western utilities are awake to how China operates. It doesn't matter how much inventory they have today. That ain't coming out of the market. That's not coming back into the market. They export raw materials in a finished product, or they use it themselves. And again, price doesn't matter to them either. And we've seen that in some of the uranium mines in Namibia. I think at $75 term, they probably just break even, and they've been operating for a number of years. And so I think that's the big difference that I've seen in multiple commodities, where China just gets in and says it's a volume game for them. What do we need, and we're going to get it.
Let's get back to the deficit, and we'll have each of you answer this. David, in your report, you cite the World Nuclear Association, which is estimating a deficit in 24 and 25 of 54 million pounds. cumulative, maybe as much as 400 million pounds by 2033. Mike says that's not even close, but what do you think to start with?
Yeah, I think the gaps later on might be closer to 400 million pounds, not cumulative. So, you know, I think right now, even if you look at, let's say, uncovered requirements by nuclear utilities, and in the next 7 years, I think they are going to need about 1.2 billion pounds worth of uranium just to contract. So it's, you know, that's not easy to come by. You know, we will have to see some incentive here in the market to not only get some of these past producers back up and running, but we need some more drills in the ground. We need some more discoveries, because there's not an awful lot of, you know, DASs or arrows or triple Rs out there that people can rely on to actually deliver big pounds into the market.
Mike, why are those numbers way off?
So, well, there's been a lot of destruction. You know, a lot of times people look at price as what price will bring on supply. That horse left the barn, and I spoke to the annual meeting of the Nuclear Energy Institute, which represents all the fuel buyers in the world, back in 2019, and you try and tell them you've got to start paying higher prices for contracts, because it's not the price so much. Of course, price has to incentivize it, but it's been a decade of no work done. And I mean, some really good, smart people in the room have advanced projects, but it takes a long time to build a mine. It takes a long time to find a talent to build a mine. So it's going to take a lot longer than people think. As far as the WNA goes, they use a source called unspecified supply in their modeling. Because there was a uranium cartel in the 70s, they decided that when you are modeling, they don't want to use price as what can come online, which is about as dumb as you can imagine, right? Imagine, here's all the supply in the world. Well, there's a lot of uranium. It's how much economic uranium can be done. So they have a category that shows it will fill the gap of unspecified supply. Well, Guy finances projects, I finance projects. I'm not financing uneconomical projects. And so it's irrelevant. And on a demand side, right, you have to think about who the constituents are that form the demand. Who the constituents are that form the demand committees are global nuclear power plants. Where do you think they want demand to show? So, you know, and again, that was our conclusion from modeling these things out when the price was 18, and here we are at almost 100, right? So I just think that the numbers that are out there, whether it's coming from the bellwether industry forecaster or these, there's you know, show me the incentives, I'll show you the outcome.
But also, Mike, I think as well, even in that planned and prospective category on the WNA, there's a few projects in there where you say, whoa, right. That needs a lot to go right.
Right.
And that's just to get to the low demand scenario.
Yes.
So back to David's report in terms of price assumptions. Red Cloud has raised those somewhat, looking at an average of 120 US a pound this year, and then out to 2027, 175 a pound. And David, you also argue that adjusted for inflation, again looking at that previous cycle, we're only at kind of halfway there to that peak back then.
Yeah, that peak was June 2007, and you know what month I started covering the uranium sector? June 2007. Right? So that's been my life for the last 15 years, watching that go down and then bump around a little bit. But you know, yeah, if you were to you know, inflate that, or use today's prices, that's about $195, $200 a pound, right? So you know, we are back to sort of a divergent uranium price. You've got the spot price, you've got the term price. Everybody focused on that spot price. Well, they still do, right? You know, in 2006-07, that was about 9% of all volume, right? So people focused on less than 10% of the volume, but you know, really the term price is really what the utilities really want to know. So, you know, what I did do, and we saw that price diverge for a while, and then it got together again. And then, you know, when the uranium price dropped through the floor, you know, certainly nuclear utilities were not paying $18 a pound for uranium from companies. So, but you know, we are seeing that divergence again. Of course, spot is higher. So we do think spot will be a volatile market. You know, it's sort of the last minute requirements that need to be filled. You know, purchases in the physical environment. So yeah, we see that going forward in 125, 150, 175, as you said, over the next couple of years. I think what people need to really focus on, though, is the term market, right? We put out, and this was a big jump for me, going from 60 to 85. because I'd never been up that high before. But, 85 is really what we are feeding into our DCF models to help value the stock. So, it's not saying that, I think that spot is going to outperform term over the long term, because I think they'll ultimately come back together, or at least they could. But, I think we need to focus on these divergent prices. So that 85 seems like a realistic price for me. So.
Mike, you wanted to jump in?
I buy physical uranium in the physical market, so I'm in the spot market. I see what that is. And, you go back, let's use a 200 million pound demand number. That's our number. You look at the forecast, they'll show 180, 185, 190, somewhere or something like that. In a few years ago, when there was excess supply in the market, 4 or 5 years ago, you would have seen 98 million pounds trade in the spot market. Over time, it's about 80% of the market. 85% of the market is term and 15% is spot. But at the peak, when there's excess supply, it got up there. You're on pace to do 30 million pounds this year. You did 50 million pounds the year before, a little bit more. So inventories have shrunk. But the spot market is made up of about 7 or 8 physical traders that do not have balance sheets that last past a month or so. And they take in, when it's available, off-take from a mine, and it's a game of hot potato. And that's all it is for the most part. It's mostly traders churning pounds back and forth to each other. I took in 200,000 pounds, let me see if I could flip it to somebody else for $1 or $2 a pound. That's how they make their living, which is great. But it's not indicative of long-lived mines, long-lived assets, massive amounts of demand that are needed in the hundreds to a couple hundred million pounds a year in the market. And utilities themselves make up a very minor portion of the spot market in good years where you see them in there. In years where they're out looking to contract for pricing, the last thing they want to do is show up into the spot market and buy pounds. They'll buy some, but buy a lot where they're going to drive the price because it's going to move. When you see prices move, they've gone what? They've gone from 60, 70 to 106, and now they're in the mid-90s. They take a little breather, but that's because there's a couple 100,000 pounds floating around. I mean, you're talking of a $20 billion a year industry at $100 uranium. You're talking, 20, 30, $40 million that might be floating around. It's literally nothing. But yet at the end of the day, a spot price is posted, and people will make their investment decisions on that. And that's unfortunate because they're missing where the term market is. And when I said that they were replacing 37%, well, then the term isn't an indicative market. But when you're at nearing 100% replacement rate, and if history is any guide, and if it rhymes, they will contract between 110 and 140% of their annual consumption in an upcycle because they're restocking the shelves. And so as you're approaching that, then it's term economics. And that's where the focus, from at least me and Guy, that's where your focus is not the spot pounds, because we're in there, we see it, we buy it. It's not that big a deal. There's not a lot going on.
Guy, any thoughts on pricing?
Oh, the only thing I would add is with respect to spot and term is you just need to look at the lithium sector to see what has happened there. And no offense to any lithium people in the room, but they took hundreds of millions of dollars from OEMs to build their mines with no price protection, and the prices plummeted. And some of them are about to go out the back door. So, it's like, because investors wanted them exposure to a spot lithium price that's not tradable. Where are those investors now? They're all out. They're all in NVIDIA or Bitcoin or something, right? They've evaporated, and poor old lithium developer is sitting there going, "I've got a problem here." So for all that, yes, it gets frothy, and the spot price could go to $200. But if you're producing 500,000 or 1 million pounds a year, spot market can take that to some degree. If you're a bigger conventional mine doing 5 to 20 million pounds a year, no way. I don't want to see you saying, "Yeah, I'll just go and throw it in there." You saw what happened with Paladin last cycle, right? Up, down, boom, gone. So, yeah, I mean, as I said, it's visible. People like to watch it, but it's not the real indication of where business should be done. I think his long-term price is still too low. It needs to be higher. But
Yeah, well, in the term, so to understand, it's understanding market structure. the term price that emanates out of, let's say, UXC. UXC will show right now a $75 term. That's up from 68, then it was 72, then 75. The term price is struck based on the lowest offer on an RFP that they know about, on a request for proposal from a utility. Most long-term contracts are bilaterally negotiated that the price reporter may or may not be aware of. But what UXC will report is the lowest offer. So let's make it up. 10 people offer on a contract, and they assign it to a much higher price. It could be because security of supply, for geographical reasons. There's myriad reasons they don't go with the lowest price. This isn't oil. It's not that fungible. You have to, a lot of things you have to worry about. And so the price reporter will report that lowest price. And yet the transaction could have occurred at 85 or 90. And what's really critical to understand in this market right now is in a bear market, in a buyer's market, it trades base escalated pricing. They will fix a price and it will escalate 2-3% a year for delivery starting in the 4th year and beyond. When it's a seller's market, the sellers want exposure. They want market-related pricing. And then to balance it out, they put floors and ceilings in there. Well, those ceilings today, 110, 120, sometimes even higher, for context, spots at $95 a pound. The floors may be in the mid-80s, maybe even inching a little bit higher. But if you were to look at the long-term price, it shows 75. So somebody who's not doing a lot of work on the industry or just new to the industry, they'll say, well, geez, look at that, it's lower than spot, it's kind of in backwardation. No, the protection that the producers are getting is massive right now. And it's not reported that way. Why? Well, you have to ask the price reporter. We certainly do on a regular occasion. But there's a lot of misleading signals in there. But all the signals that would signal health, when you're getting $120 for a ceiling is a big deal. And they don't report that. That doesn't get reported. So it's really important to understand that what UXC will report is a 3-year price at $108, a 5-year price at $111, and a long-term price at $75. Well, that's nonsensical. That's not where they're being signed. So,
Guy, shifting gears here a little bit, can you shed some light on the Australian uranium market and how it's similar and or dissimilar to what you see in North America as far as sentiment and demand and so on?
Yeah, I mean, a lot of people, especially North American investors, sort of cringe at the valuations on the ASX and say they're pricing expensive. I think there's some Canadian, uranium companies that look at the ASX and go, wow, maybe we should be down there because of that. And the difference is, in North America, you could put $100 million to work in Cameco, NextGen, Sput, a few of things and sleep pretty well at night, right? You wouldn't have too much of a problem doing that. You don't have that flexibility of market cap and liquidity in Australia. So, when your 2 biggest companies are Boss and Paladin, they're nothing in liquidity compared to a Cameco. But there's a whole bunch of Aussie investors who now they're both index in the ASX 200 and 300 Small Ords Index. So all of these guys that never looked at uranium because it was never in their universe, it was never what they're getting benchmarked again, has suddenly seen, in the case of Small Ords, 3.5% thrown. So they're forced to buy at least index weight to be flat. And when you're sitting there and you're seeing my ugly mug on podcasts and things down in Australia saying it's going to the moon, you probably want to just make sure you get to index weight. So that's the difference there. The other thing I think in the ASX is there's not actually that many Aussie projects listed on the ASX because Australia's got some state governments that have been just stupidly blind to it. So you can actually get a bit of different sort of geographical with some Canada, some North America, some Africa. But when you look at the market caps of those companies, they're generally a lot smaller. So when the sentiment is there, that's why they tend to price more expensive. But the other thing I think you find is Aussie investors look at uranium stocks as another mining stock. So it's another commodity. So and they love their junior penny dreadfuls and good promotion and things. So they look at it differently. I think the investor in North America understands the nuclear aspect of the uranium supplying that sector, whereas, we're obviously an anti-nuclear country for a number of dumb reasons. And so you tend to get swings in and out of uranium stocks more related to mining sentiment than actually what's going on in the end demand being the nuclear sector.
We want to get to some stock ideas from each gentleman in a second, but is there anything that we haven't touched on that's important to convey? Anybody?
How much time do we have?
We've done it all. No, we've got about, let's say, 10 minutes of our portion and then 5 minutes of Q&A.
I mean, just from my perspective, I can't emphasize enough market structure and incentives. Just stare at them, learn them, and you won't be guided by day-to-day spot price movements or whatever. It's an upside-down market. It's a broken market. The uranium market is broken. It's dysfunctional with infrequent price discovery, which creates unbelievable asymmetry. It's people on the demand side who are just hoping their reactors would stay open for years. And the cost of uranium, the front end of the fuel cycle, uranium conversion, enrichment, fabrication is 22% to run a reactor. The uranium itself is 30 to 40% of that. So it's single digits. Natural gas and coal are 80% of the feedstock, right? So there's no substitute. You can't do coal to gas switching. So the fuel buyer, over years, they buy long-term contracts. They're infrequently in the market. They're not financially incentivized to buy low. They're financially incentivized to make sure those reactors don't run out of fuel. And they will pay what they need to pay when they pay it. It also creates an amazing herd-like mentality that will just follow each other. And so it's important to understand that structure. And it's important to understand what the forecasters, what drives them. And then there's where in that fabric is where the disconnects lie.
And Mike, you own uranium equities, but you'd rather not comment on that specific ideas, correct?
Yeah, we don't talk about the individual company. I mean, we file, so you can see our filings, but I don't like to pitch ideas.
Fair enough.
So many of them in the room.
Yeah, I don't know.
I think Guy and David are willing to give us a producer, developer, explorer, and a quick snapshot as to why they like them. David?
Yeah, sure. I'm just going to reiterate some of my top picks that I had in the report.
Yep.
So, if we start a producer, I think Energy Fuels is probably the one you look at. They were, largest producer in the U.S. over the past several years, and I think they're going to get back to that. They're probably not going to hit it this year, but they did decide to put White Mesa Mill back into production coming later this year. They've just restarted or started up 3 mines that weren't in production recently. So, and then they've also added a rare earth oxide circuit into the mill. So that's something that they're looking to deliver monazite to and start delivering into the rare earth sector as well. So I'd say on the producer side, Energy Fuels.
All right.
I would say check redcloudresearch.com for disclosures.
Yeah, and that's complementary research, shall we say. Go to the Red Cloud Securities website and click on research, and you can get all of David's reports and much more. Guy, a producer from you?
So to avoid controversy, I'm going to focus on the ASX. So just so I don't get spat on the way out the door. I mean, it's been no secret that my biggest position that we've supported basically since we looked at this in 2017 has been Boss Energy. We got into that in current dollar terms because I did a share consolidation about 32 cents. In both the Global Natural Resources Fund and my uranium fund, and I think it topped out at $6 and change the other day. It goes to that whole idea of it was a care and maintenance mine that was brought on very quickly in the last cycle as a non-core focus of Uranium 1, had some technical difficulties, low prices, shut down. Bring in a good team that was able to de-risk it through a period of zero interest from institutions. But more importantly, it's in a good jurisdiction, being South Australia, where obviously you have Beverly Heathgate running there with General Atomic and obviously Olympic Dam at BHP. So a lot of expertise, good team, and good jurisdiction, as well as a good ore body that just wasn't an ISR as well, so it wasn't well understood. So that has been, and I was out on site in early February. In fact, I shared Valentine's night with Duncan and the construction team on site, much to my wife's bemusement. And so they're coming along fantastically. A lot of people say it's expensive and it's pricing expensive and things. I think the deal they did with Encore was a phenomenal deal. It opens up some serious strategic advantage for two movers that have come a long way. And if you think about it, Encore wasn't even in existence that long ago. And so, it remains my favourite stock, even though it's pulled back a little bit. But, it was also, I think, one of those stocks, because of the index again, where in that last raise, when they did that for the Encore deal, our ASX 200 long-short fund participated because it's index. Our small cap fund, because they're in the small cap, small odds. So it's the first time that a bunch of funds in Tribeca have all gone into one deal in some size. So that, as I said, I'm going to stay ASX. When you look at developers, the interesting thing in Australia is, with Boss and Paladin coming to market now, there's a lot of focus on what's next. And so, of course, the ultimate, they're all going to become Rays, and that was Deep Yellow, Bannerman and Lotus. Lotus has pulled the Band-Aid off to get rid of that equity overhang. And they're all sort of, I guess they are final investment decisions. I mean, it's funny that, Bannerman that we bought at 4 cents all those years ago, thinking, wow, high cost, but whatever, we'll see what happens, is now towards the top of that stack. And then when you look at valuation as to who's developing, I mean, Peninsula is obviously in the ASX, pricing extraordinarily cheaply versus those names. It's a name we've been in for a while as well, and we'll see Wayne progress that. With the explorers, I'm looking for people that are doing things. And when you look at an Australian focus, there's, again, people saying, I've got this, but it's in Western Australia, I've got this, but it's, and I look at that and who's doing things on the ASX. DevEx are doing something in Narbalek up there, Alligator Energy are doing something in South Australia. So, I want to see that because it gives them something to talk about, to get, retail investors love to hope that there's going to be a 50%, uranium drill hit and something. It's not too high grade, but, and so, that's where I'm looking for there, because it's going to be hard to compete for attention as an explorer in the next sort of 6 to 12 months as a lot of last cycle projects or new tenements pegged all come and try to say, hey, look at me, I'm fantastic. So sorry there's no North American things, but as I said,
You didn't mention Aura Energy. Aura Energy listed on the ASX as well.
Yeah.
They've got a couple things underway as well. Sweden is looking to probably overturn its uranium mining ban come May. They're looking at that now. And, that's not even my favorite project from them. I think I like the project out of Mauritania that, is really free dig. It's all above 5 meters within surface. They just put out a feed study a couple of days ago where they're not going to step it up from 800 to 1.6 million pounds. They're going to go straight to about 1.92 million pounds production there. They're essentially right-sizing the asset in this kind of environment. So, the capex on that about 230 million, and the opex in the call it the low mid 30s. So it's it's a project that we're following as well. If I do have to make my top pick on the developer side, it'd have to be Global Atomic. I do think they are working through the geopolitical issues in Niger. Yes, they do need to go back to democracy, and that's going to be supported by the U.S. The U.S. is going to stay there. The military is going to stay there. They've put a new ambassador in place there, and she's very, very good, knows Western Africa very well. The Western African nations just opened up the country as well last week, so that's going to change things. They're also actually going to be able to resume commercial flights and get products across borders, so that's positive. But you just look at the size of the deposit. You're looking, depending on cutoffs, 130 150 million pounds. But, you know, the phase one right now is only looking at 44 million pounds. It's 0.5%. You know, that's the highest grade outside of the Athabasca that's going to be mined, right? So I'd expect them to put out a resource estimate here shortly and then update their feasibility study. I think phase one alone is going to, you know, potentially double here. And that's going to be just good for the story. They've already ramped it down to the asset, to the deposit.
Right.
So they just need some, they'll raise some debt and finish off the processing plant, and it's game on for them.